said, my name is Jasper Breebaart. In the 18th century, in Holland there was a guy who's called Peter Stravinsky, and he was from the, they called it Liberal Party back then, where they were like the Patriot Party, and he wrote pamphlets. He was a fan of the French Revolution, and especially the American Revolutionary War and the new country they were building there, etc. And he realized, I want to do something more than just writing pamphlets. I want to put my money where my mouth is. So he started to think, how can I also make some money off of this new country? How can I invest in this? So during that time, a new financial invention was in Amsterdam, and there was the closed-end mutual fund. And the closed-end mutual funds, it didn't exist before. They came up with the idea of actually creating it. So one of the first closed-end mutual funds is called Eendracht maakt Macht. And it was a whole eclectic combination of investments in Danish tolls and the postal service of Saxony and government debt from a couple of countries and river income and peat production in Brabant and plantations in Suriname. And it was all this kind of very diversified fund. And by the way, the way they structured the fund back then, at the beginning of the mutual funds, you would get a 4% return on your investment, and the excess cash they would pile up, and when it hit a certain threshold, they would hold a lottery, and then they'd pick out one bond they would redeem at 20% profit. And if you're the lucky ones, you would get a 20%. Oh, and the two bonds that were next to it from numbers would get their return bumped from 4 to 6%. Talk about complex financing structures, by the way. So that was the mutual funds that were there. And during this time, as I already said, we had the Revolutionary War in America. And the Revolutionary War started, America won, and there was a slew of American government debt because they financed the war against the English with government debt. They paid all their soldiers in IOUs, and there was a lot of government debt. A lot of investors from the continent didn't want to invest in it because they didn't think that the country would exist or something, keep existing. So the value dropped to like 15 to 20 cents on the dollar. And here in Holland, Peter and a lot of other Dutch investors intrinsically already had a warm heart towards the American experiment, because in Holland, for Republicans, we have a royal family that doesn't really exist or doesn't have power. We've always enjoyed this thing. So there were a lot of investors in Holland that really wanted to help the American experiment, and as did him. So they bought government debt and they securitized it in the mutual fund system. So they bought the American government debt for like 15, 20 cents on the dollars. Then this guy became the first Treasury Secretary, Alexander Hamilton, and he realized to turn America into a country, we need like a national debt. We need to reorganize this debt structure. So in 1890, he wrote a report where he basically said, we need a national debt, we're going to reorganize this, we're going to change this. He put the idea towards Congress. There was a lot of haggling around it and for and against. It now turns out that most of the congressmen were also speculating on the American government bond, so it wasn't real. But all right, and later on in the year it got passed and they reorganized the American debt. And the Dutch investors made a mint. I mean, it went from 15 cents to like 80, 90 cents on the dollar pretty much overnight. So there was this big group of Dutch investors that became super rich from American investments. And of course then FOMO kicked in the Netherlands, because that's how finance works, of course. So then everybody wanted to invest in American securities or American funds or something like that, but they did not exist. And that allowed for something to happen, which was a theoretical idea before that, but never actually was able to put in practice, which they then called a land bank. And a land bank is nothing else than a CDO real estate. And so the first real estate CDOs were created to satisfy Dutch investors to invest in America. They did it to develop land in New York and in Washington. So a lot of the Washington old monuments are actually financed by Dutch investors in the CDOs. And as luck will have it, 240 years later, this was exactly the product that brought America down, which is, it kind of created there and it brought it down. Now, why I tell this story? Because we think that it's very hard to predict what happens in the financial markets. I mean, some kind of coincidental situation in Holland created into CDOs, and anybody predicting this is kind of impossible. And we currently live in a world where the world is changing super fast, And predicting this, we don't believe you actually can. I'm going to do the next one. If we look at geopolitics, we don't think anybody can predict it, but we do think you can see where we are. So for the people who haven't heard of this, Ray Dalio is a hedge fund manager, has a very big idea about this. I'm worth it to figure out. What he basically says is every empire, both economically and it's all together, goes up and goes down. So we've had here China, then we had Holland, then we had England, then we had America, and this is where we currently at. And every development of an empire starts with we have a new world, prosperity, we get a debt bubble, we get a huge wealth gap, then we get a bust, which is 2008 obviously, then we can have printing money and credit, then we get revolutions of war, and then we get a restructuring, and then we get a new world order. Now, it seems obvious we're somewhere here. And then again, we can't predict this, nobody really can, but that's the point I'm trying to make. Nobody can predict this. Next one, please. The world is not changing from a geopolitical standpoint. If you look at how companies are valued, we have the focus on profits is at this moment completely down. In the 70s, 80% of the share price was correlated to the profits that the company made. Currently, we're close to 0%. The strongest correlations are R&D spending and SG&A. Cash has not been king in the past couple of years, which you hopefully all know by now since you're investors. 30% of all public companies in the US have a negative cash flow. 75% of those have come up over the past years. We live in a very wacky time. Next one, please. And of course, you know this from the fact that debt is something that everybody lives on. From governments, the American government debt, I think everybody knows that it's rising and it's not really looking to go down. Same thing happens with companies. Over the years, on average, companies have taken on more and more and more debt. And this is not just in America or the West, this is all over the world. We see every country, this is France, we have America, we have China, of course, in every country, companies are increasing their debt load, Next one, please. One would guess this is going to blow up at some point, which I guess most of you are value investors, so that's kind of our standard way of looking at this. Same for me. There is a counter-argument though, because the counter-argument that you get is, this time it's really different, which I doubt it is, but you get the idea, because we live in an exponential age. And you always live in an exponential age, but exponential growth goes up, and the further you get, the faster the growth is. The only solution to the current valuation is we grow out of it, which is not impossible. The problem with exponentiality is that humans are not evolved to understand exponentials. So I have here the FANG stocks between 2012 and 2021. Now, if we look at this, and again, most of us are value investors, including me, if I look at this, you think this is a bubble. It went up a lot, this one has to go up, needs to go up. Next is. If we re-show this, but then in a logarithmic scale, so in other words, show it as it would be in correct for the fact that there's exponential growth, we actually see a growth trajectory that's quite rational, quite normal. Within it is some overvaluation, undervaluation, but at the end of the day, it's just the growth that is actually there. And we all get this exponential growth idea, of course, now in the age of AI. Is the question, is it going to change everything? Now, next one, please. In our industry, we already got this. I don't know if you guys already played around with this, but these are two ideas you can play around with. One extra. These are AI shells they put over Excel, and it's literally, we have this in the front, you literally say, this is the input, this is the assumption, make a DCF for me, and it makes in 30 seconds a well-functioning, perfectly working DCF, probably better than I would have done it. And the beauty here is you can literally upload your assumptions and the research reports, etc. that are there. And it's not only DCF, it's term sheets, the whole thing that's going on. Next one, please. This is another one we are using, portrait analytics. So hit it. So basically, it allows you to search, filter, and news not only on quantitative figures, but also on qualitative figures. So here you figure out, give me turnout opportunities where the management is changed and then the management had that much experience, etc. And it literally gives you results. The other one here, can you put it together? So the thing to do, alert me to any data points that disconfirm my thesis that they already know, and it will, convince you that. I heard of a 100 million small cap fund. They were a couple of months ago. They were creating a new position. So they were writing out what the person they were going to hire needed to do. And for writing it out, they figured out that 80% of that work was actually already doable with AI, and they scratched the position, and now they just have AI tools doing it. So
is this stock specific or for anything?
This is stock specific. This is made by like 5 analysts from Goldman Sachs and stuff, and they are.
Does it cover all markets or mainly US?
All markets.
Okay.
Yeah. All right. So next one, please. We wanted to create a fund, but putting this all together, we're in a time which is really unpredictable. It's really weird. So when we created a fund and when we were investing, we thought, what are we going to focus on? How are we going to do it? So we went back to Howard Marks, who had the perfect quote: "You can't predict the cycle, but what you can know is know exactly where you are in the cycle. You know if you're at the beginning or the end of the cycle. You don't know when it's gonna burst, but you know you are there somewhere." Now, this is where we're currently at. So, past 25 years, 30 actually, of data. Small, super cheap; value, super cheap; ex-US, super cheap. This is where the opportunities are at this point. Hence, our fund, next one, we focus on that. So what we have done, we have a value growth split. We do 80% value, 20% growth. Of course, one could debate on the definition between growth and value. We prefer if they actually coincide, but we'll get back to that. As I said, we focus on small and micro caps. More on that later. We focus on healthy companies, little debt, cash flows, no, in 20 years we're going to be profitable. We tail risk hedge, a little bit more on that later as well. We want companies where there's skin in the game, because we have skin in our game, in our fund, and our CEOs always have skin in the companies, otherwise we just do not invest in it. And we have an external administrator, and these are the rules we have in Holland. We have set it up that basically we only work from a performance fee, although that doesn't really work in practice, but practically we have a performance fee and nothing else. We only make money if our investors make money. All right, I want to zoom in on 2 things. First, small cap. In 1999, Warren Buffett, everybody knows him here. I already saw, oh yeah, you had the Berkshire. Did you go to the shareholder meeting when?
The last one.
Oh, the last one. All right. I went in 2019, because I was never there, and I figured I have to go before they die, because you would kill yourself, And so luckily I still had Munger there. Yeah. Okay. Anyway, so in '99, somebody asked you, what would you do if you would start over again? He said, well, if I start over again, I would make 50% a year. I can guarantee you I would make that. How? By knowing everything there is to know about small. He said, we don't have the opportunity, but if Warren Buffett would start over, that's exactly what he would do. Focus on small again. Next one, please. Now, I don't think I have to explain here why small is better. It's more stocks. On average, the return is better, which makes it really good now, because the return has been worse over the past years. So statistically, it's likely that it's going to be even higher in the future. There's higher potential. There's not, as you all know, there's not an efficient market. We don't have, big funds following it. We don't have analysts. We don't have etc. And we had a couple of funds in our position, and they went up 20% for the only reason that there were no analysts following it, and there was one analyst somewhere who started following the company, and that just really sold it in the bottom. But there's also another thing that makes it, in our opinion, interesting in the future. It is a viable alternative to private equity. Next one, please. And this I need to dive in a little bit in. So, research has shown that private equity and small cap investing is pretty much the same thing. If you think about it, it makes a lot of sense, because what does private equity do? They buy small companies and they sell it again at a later date. I mean, it's kind of the same idea. So PGIM did a research where it says the same. O'Shaughnessy did research where they actually said the mid-cap returns were actually a little bit better. But the point is, it's comparable or better without limits on liquidity. I heard from a funds manager a couple of weeks ago. He was speaking with a cancer researcher in America from one of the top universities. And they were talking about the cancer research, and he said, well, we had to fire a couple of people because of the Trump cuts for research funding. And the fund manager said, well, why the hell don't you get money from the endowment? If there is a ever a reason to have an endowment, it's actually this. And the answer from the cancer research was no, the endowment is all invested in illiquid investments, so they don't have money to actually pay us. The fact that the cancer researchers knows that their endowment is not liquid is mind-blowing even. So that will come at some point. Anyway, if you want more info on this, we have a white paper on the website where we specifically go into this idea. Next one, please. Bill Ackman, in January, February of 2000, he heard of a virus in China. He got worried a little bit, he started to do some research. At the end of February, he figured out, all right, there's a possibility that this virus is going to go all the way, and we need to do something about it. So he looked at his portfolio, he figured, how can I hedge the portfolio? So what he did is, he bought credit default swaps on corporate debt, with the intention of hedging the portfolio. Now, we all know what happened, of course. The world went in a lockdown. A couple of weeks later, I think he held him about 3 to 4 weeks. He 100x'd his investment in the credit default swaps. Now, what he actually said, if you ask him, when people asked him about it, he said it was actually a hedge with an asymmetrical element in it. Because the beauty of it was, if the virus would just kind of peter out and not do something, it would be a very small cost on my future profits, just tiny, it wouldn't be that painful. However, if it actually went the way it actually did, we get a large payout at the moment when the shares are down, which we can reinvest at the right moment. This is exactly the idea we have with hedging. So what we do is, we figured that we did some research. Now, on average, every 5 years, there's between 1 and 20% drawdowns in the market. So what we do is, we buy cheap out of the money put options at approximately 20%. This costs us maximum 3% of returns on average, especially now because options are fucking cheap. Like 1.2, 1.3% of return it currently is. And we get the insurance we need. It actually has more than just the insurance, because our customers love it because there's psychological comfort. We still live in a period where, especially people with a lot of money, they easily spend $1 million on real estate and don't think it's risky. But putting $1 million in the stock market, they like lay awake of it. It's a really weird time where we're living. Another advantage is we can take more risk. We do not need to diversify into bonds or something like that, which I think is a horrible investment in the coming 10 years, but that's a whole different story. But we don't need it because we are insured. And finally, just like Bill Ackman, we get a large cash infusion at the moment when everything is cheap. On the, what was it, the 5th of April, Liberation Day?
It was 15%, right? Or
Yeah, it was, but still, it didn't work out perfectly, but still, because the VIX went over 50, we still had we had about a 10% return from our 10% fund return from our hedges, which gave us a lot of capital to just buy other stuff that was super cheap. So that's the idea behind it. Now, why does this work? And I'm now going to geek out a little bit on you guys, but I've made it simple. Next one, please. There is a problem in the current mathematical idea behind finance, because there is actually the math that we're all using now is wrong. The point is this. Here's a hypothetical. We invest $100,000 in a market or in something. We expect a 13% return. There's a 10% chance of a 20% correction. Hedging cost is 3%. So this is the situation. Quite comparable to how the financial market kind of is. Now, that means that if I hedge the portfolio, it costs me 3%. If I don't hedge, I have a 10% chance of a correction. So in other words, if I have 10 outcomes, the likely situation is, here I have a 20% loss, the other ones I have a 13% outcome. Now, for the people already good at math, they already figured out the expected value here is minus 1,000. In other words, from standard mathematical rules, this is not a good investment. This insurance is too expensive. And any quantitative finance guy would not take this insurance because it's more expensive. If you're not super inclined in numbers, you can kind of see it from the fact your total loss is 20,000, your total loss for insurance is 30, so in other words, why the hell would you insure that? However, there is something wrong with the way we calculate this. Next one, please. Because The problem and the problem that we do here, we use statistics that are based A, on linear thinking, and B, that are based on doing it one time. But if you're investing for 10 years, you're actually making the same decision 10 times in a row instead of one time. Which means that if you have a loss, the loss you have influence on your return, your absolute returns the year after. So if you smooth out the loss, your returns will actually be higher. Now, to give you the idea about how that works, let's say we run this for 10 years. And somewhere in the 10 years, you're going to have a loss. We're going to assume the 10% is going to mean it's going to happen one time. So you can either have a loss in the first year, you can have a loss in the second year, third year, fourth year, and all the other years are well. If you then use these numbers, in all these situations, you end up with $240,000 because there's 1 year loss, 9 years of 19%, that's your return. If you do the same thing, but you insure it, and it doesn't matter where it's insured because it doesn't change the difference, you actually end up with $259,000. And the reason is so the expected average return without insurance is 9.7, with insurance is 10. And the reason this works, or this is that way, is the way we calculate averages in all of finance, but pretty much all in the world, is based on a linear calculation. But you should use exponential calculation. So the whole way we actually do it is wrong. This is called the St. Petersburg's paradox. This is a whole new branch of economics that is currently being developed. It's called ergodicity economics. I came at track of this a couple of years ago, and they had the first conference. It was an online conference, so I joined it, and there were like 25 people, and one of them was Nassim Taleb. That was actually on the conference. I was, all right, I'm onto something here. And they already knew it, so Nassim Taleb and his partner Spitznagel, they have like a tail hedging fund thing, and he already wrote a book on this, Spitznagel, I think in 2015 or something, where basically the way we calculate our insurance just doesn't work out. We make a mathematical mistake in this. If you're interested, A, we have a white paper on it, but B, as I said, ergodicity economics, they're trying to build this into like a new way of actually looking at economics, and I'm pretty sure this will become more and more known, because as you can see, there's literally a mistake in the way we calculate expected returns, which of course makes CAPM a completely horrible concept. All right, next one. Now, it's pretty much the end. I didn't want to leave you without a stock tip. So I picked one that is actually in our fund, and that's one of those stocks which is both growth and value. So it's not a short-term play, it's a little bit long-term play, but this is the one we really like, where it's very hard to call it growth or value. The company is called Agronomics. It trades on the London Stock Exchange, and it is actually a fund. It's kind of like a venture capital fund. So it's a fund that invests in clean foods, mostly in lab-grown meat, but also in other variations of lab-grown and grown foods they create. They invested in approximately 20 companies. At this point, it's like 23 or something. What's specific about the company started by Jim Mellon, which is quite an unknown guy, but a super successful investor. They call him the Warren Buffett of England, which is kind of a bullshit name because he's like not a different thing, but all right. He's a billionaire. He's very good in predicting trends within the markets. So he predicted the internet in the 90s, then he predicted the financial crisis in the 70s, or at least the financial problem. Then he predicted the redevelopment of the internet with the big companies now, and now he basically focused on a couple of trends. One is juvenescence, which is living longer, all the companies that go to people living longer. The other one is clean food, and he's now into humanoids. Is also one of his new things. And he always does it. And however, what he says is, if you want to invest in a new trend, because the thing is, you cannot predict the markets, but you can see the trends that are coming. You don't know when, but they will come at some point. But he said the problem here is, he said his example is the internet time of the internet bubble of the 90s. Even if you would have seen, oh, this is going to revolutionize the world, still, which companies do you pick? I mean, the reality is that all the internet companies back then, only Amazon is the only one that actually survived and became big. All the other ones went bankrupt or were taken over. So his idea is to play that market, you cannot pick, but you need to just buy across the board and see who comes out as a winner. So what he did is he created a fund, which he, at this moment his ownership is 16% of it. He owns 16% of the fund. And they invest in all these companies. They have 3.6 million cash equivalents. At this point, they're pretty much done with investing. The last couple of investments were done in the last couple of months. They've already run for a couple of years. Annual cash burn is approximately 100K, but it could be a little bit lower because what they also invested via a couple of loans, which completely pay for the day-to-day operation, so it's a low-cost thing. But the point why it makes it value is it currently trades at 55% of NAV. So it actually is at this point quite a low. And NAV is to 145. Market cap is 65. This is not one that's going to get to 100% in a couple of months, but I'm pretty sure in the long term you can actually get into a new trend in investment for quite a decent price. All right, thanks one. Now you can do one more too. So, but it's closing. Thanks. Any questions? Yeah.
Wait. Well, yeah. So I was wondering, how did you define the NAV? Because it's like a lot of investments that probably are not listed.
Yeah.
So how do you know that NAV is actually worth it?
So the way because they actually provide for you, but so they have three methodologies. Some of them are quoted, where it's simple, obviously. Some of them are based on new funding rounds, which is then the new NAV. And if they don't have that, they keep at the original investment. So part of the reason why it's that low is that they just invested more and the share went down afterwards.
Cool, nice.
Yeah. Yeah.
Oh,
Okay.
thank you very much.
Thank you. It's working?
Yeah.
Yeah, it's working?
Yes.
No, I just had a question on the cash burn. Is that at the holdco level, or does it capture the cash burn of the participations? Because I guess it's a lot of startups and. So
no. It's holdco. So in other words, the fund in itself is not going to run out of cash ever, or needs to, if he would ever need to is going to dilute or something, it's because there is a great investment that the shareholders want to participate in. But his plan is basically to just invest, wait it out as long as it needs. That's kind of the idea.
And are these companies like requiring recurring cash injections from that?
Some of them do, some of them don't. It depends. So one of the biggest ones is called Mozambique. It's a Dutch company, coincidentally. They only have 3% in the fund, but it's quite a big company, and it's one of the most advanced ones. And this one, for example, is now actually at the point of building a factory, which of course they have an enormous cash need there. But the factory is now financed by normal bank financing instead of so it really depends on the type of company and the type of operations there. Some of them are already cash positive, so they're like the slow growing part of the market. And of course there are some that are just like startup VC kind of style, funding round is funding round and trying to get the idea.
Yeah. And then I had a second question on the insurance you're using.
Yeah.
I think you had a slide where you showed the difference between expected return, uninsured and insured.
Yeah.
And it kind of surprised me that it was only 30 basis points. So does that mean because you have a lot of basis risk and it takes some time and potentially it distracts from your strategy of finding investments. So is it worth the hassle for 30 basis points? Do I read it right, first of all, that with insurance the return is 10 expected?
Yeah, but of course here this was just a for instance situation, because the problem if you don't want to do a calculation, of course you don't know beforehand what your return on your funds can be, etc. And the reason why we think it's worth it is because as I think I've shown and the math shows, if you're insured you actually increase your return even if the insurance is mathematically too expensive. B, you don't have to think about diversification or defensive or etc. because you will be insured for that, so you can take a little bit more risk in the fund. And C, and that's in my opinion the most important one, you get cash infusion the moment when the market is cheap. And that one is not, you cannot put that in numbers beforehand, because how the hell are you going to predict what your return on that's going to be? But the reality of the fund is going to be, as I said, we saw it in April. We had a shitload of cash available to us at the moment where everything was super cheap. And that is, we think that is where the hassle by itself already. Because you're kind of like a fund that has the opposite situation of what they normally have. Normally they have cash outflows when the market goes down, and we actually have cash inflows, which is exactly what you need. So that's why we think it's worth it. And we now live in a world where options are ridiculously cheap, because there's a lot of hedge funds playing it, a lot of, so I mean the cost of the hedge is super cheap. And we don't actually hedge the individual names, we just hedge the overall index.
Yeah, that was my next question.
Yeah, that was because it's also that I looked at it when at the big drops, everything drops, but of course the most hyped names will drop most. So I kind of want them to be the majority of my hedge. And in April you actually saw it worked quite well, because the drop was not 20%, but it's still, we compensated for 2/3 of the loss. Although we weren't really insured for that situation, because normally markets don't drop 15%, they drop more. But now we had a man-made crash, which was kind of, it's been a while since we had a man-made crash before. So that was only 50, and even then it worked.
Interesting.
Yeah.
Rolling 3 months or?
Well, what we do is depending, so we roll it from 3 months, and we keep rolling it, but it kind of depends. Quite often over the past years, we have not sold out the 1 month because it turned so cheap that it was like, why not get the extra coverage for a couple of $100 kind of thing? Because again, we don't expect to do it in the long term, rolling through 3 to 2 months, but at this moment the market's so out of whack, it's so cheap, so we're actually kind of overhedged because it doesn't cost anything. And so
actually, just a very short question. How convicted are you that Jim Mellon might increase his position? Because
oh, he's not. No. The point is, I'm convicted. He put the money in. This is his part of it. This is how he invested in it. He just makes sure that the company's run, and he's just gonna play out the strategy. So
like
my earn-out event is not going to be him buying more. The earn-out event is these companies being bought by the Unilevers and etc. That's what the earn-out is going to be.
But couldn't this be a plausible earn-out event as well? Like, given that he's a billionaire and given that it's trading at...
It's not unlikely, because if it becomes, and I emailed, because it was actually quite interesting. Because I was in it, and I figured I would just do jim@economics.com, and I emailed, and he replied, and we started to the email chain, and so he basically said that's not my intention, but he did say to me, if it becomes really ridiculous, I'll probably do something about it.
Thank you.
Which was the, what the hell can you do with those words, but yeah.
So I was wondering, when you put the hedge on, do you decide discretionary when to monetize that, like if it goes into the money, or not? And as a fund manager, I'm always interested in how do you describe that into your
documentation.
Documentation.
Yeah. So to start from the back as to the front, we intentionally did not codify that into our rules. Practically, we have VIX levels. So we identified at what VIX levels it is likely or unlikely that you get that it goes higher and lower. This is exactly where we sold on the Liberation Day on Monday morning. Why? The VIX was over 50 at that point, and that only happened 34 times from 1930 until now. And it's just unlikely that it's, so that was when we sold half our hedge position, because although it wasn't at 20 yet, it was, it seems unlikely, so we have codification based on the VIX numbers.
That's cool. Thank you.
I have a question. I suppose you're hedging like the American market, right?
Yeah.
But then you're like invested in like economics in the UK, so like you kind of hedge a different market then, like
definitely.
How do you think about that?
Yeah. So the concept there is the 20% crashes, the market crashes, historically has always been all the market everywhere. Because when it goes that bad, it's not idiosyncratic, it's systemic crashes. And therefore, we hedge where we get the cheapest and the most overvalued situation. So in an ideal world, and I was looking at it at the end of February, end of March, retrospect, it would have been a great moment. I was looking at how expensive it was to only hedge the whole portfolio at FANG stocks. Because they're so high, and then, but it turned out that the vol was actually too high, so it didn't actually work out. So we will pick the ones that it has a correlation between highly valued and cheap, and the one that fits better. And for the foreseeable future, I'm doubtful it's going to be anything else than SP 500 at this point. But hey, we're flexible to if the situation changes, we'll pick another hedge that is more overvalued and better. Yeah.
So your original investment, I think your investors invest in euro.
Yeah.
And your hedge is in dollar.
Yeah.
Is that a real hedge?
Yeah, it's a real hedge, but there is currency risk.
Because you're losing a lot of, or you're taking a lot of risk, currency risk.
Yeah, there is currency risk in there. We hedge the currency risk of the positions, but obviously not of the hedge.
No, that's
how the hell are you going to exactly? And we just accept that.
You accept it?
Yeah, we accept that, and that we accept it for the fact that it's so much cheaper and at this point more efficient from a volatility standpoint to hedge in America than to hedge in Europe. But if that switch, we will switch.
But basically, me, I think a lot of us have the same problem that the dollar lost a lot of value without your hedge protecting you against.
Yeah, but so if you take it from a hedge standpoint, we're currency hedged always. So we already have that element covered within normal positions.
So how much does that currency hedge cost you then? Because you said that the other hedge was like 3%.
Yeah, but now it's so currently it costs 2 basis points to hedge US dollar. Okay. So that's decent. And other countries are cheaper, obviously, because it kind of depends, of course, on the interest rate differential with the Euribor and the LIBOR, depending on what country you have. So the hedge in Canada is a little bit cheaper. The hedge in Japan is actually makes us money at the moment, so it kind of depends. But that is the currency hedging thing is a act we haven't cracked yet, and we pretty much accepted we're not going to crack it, because we've also had situations where we just halved our currency hedge because it was getting too fucking expensive to hedge the dollar. Yeah. So it's just one of those. We always have to kind of keep into mind and kind of accept that we're going to have currency risk. If you invest international, that's going to be the case, I think.
I mean, the benchmark where you're playing against, you're probably using something like a world index or whatever, and that takes on currency risk as well. Right? Exactly,
and our communication to our customers is we put it against the S&P, the Russell, and the world. Because the reality is, I mean, what the hell is a good benchmark here? And that's what we really communicate, like, dude, there is no benchmark, and there's no point in being in this fund for a year. You're either in it for a long time, and you get decreasing fees. That's why we do have management fees, but it goes down and down and down to keep people in. But the reality is, it's very hard to get a benchmark against this in any scenario. So.
Are there specific industries or sectors you're looking for in your investment, or is everything possible?
Not specifically. There are a couple of things we do in a certain period or will hardly touch. So the reality is we look at where there's value. So at this point we look a lot at shipping, at oil, because that's all super cheap. So we find a lot of value there for the value part of the portfolio. And we do a little bit trend things. So we for the growth part, the long-term growth, we look at, all right, this is a trend that is coming, and we do like a deep dive in the industry to try to figure out what opportunities are there. But it's not that we specialize in one thing specifically.
And you do all the research yourself, all the industry deep dives, or is this?
Yeah, so we do two things. We're together. We do it. I have a partner with the fund manager together, and we both have a decent network in the industries where we really need help. We build a network in people we can call and get information, that kind of shit.
Okay.
Yeah. And of course with the AI and with the new tools, I mean, it gets easier and easier by day. It's like ridiculous. Yeah. One tip, by the way, for the small investors, I kind of already got it. If you want a good data feed that's super cheap, it's called Wise Sheets. It's like $100 a year, and you get instant data within your Excel files. all data all over the world. So from market data to company specific data to all the quantitative ones. It's the cheapest one we find. And if you're good at building models, Wise sheets. Yeah. If you're good at building Excel models, this is the cheapest solution for you to get to model.
That's true.
Yeah. Other questions?
No questions anymore. I think it's also time to send.
Yeah. All right. Thank you very much.